Welcome to this deep dive training program on structured intraday trading and market psychology. This 2-hour program is designed for serious intraday traders and focuses on structure, discipline, and psychology. Here is the program flow for the 2 hours. We will cover the reality of intraday trading, market psychology, a structured trading framework, case studies and scenarios, and finally, discipline, journaling, and a question and answer session. Let's start with the reality of intraday trading. We will explore why intraday trading looks easy on charts, but execution often fails in live markets. Remember, speed magnifies emotional weakness, and one mistake can ruin your day. Common trader expectations often include a daily income mindset, high accuracy expectations, and a desire for quick recovery after a loss. Many also believe the market owes them profit, which leads to poor decision-making. The intraday market reality is defined by uncertainty every minute. There are no guaranteed setups, and losses are a part of doing business. The key priority should always be survival over profits. What is market psychology? The market is collective human behavior. Decisions are driven by fear and greed, and logic often disappears under pressure. Price moves on emotion, not just news. Retail trader psychology is often marked by the fear of missing out, or FOMO. Other common traits include the need to be right, ego attachment to trades, impatience, and overtrading. Institutional behavior contrasts with retail psychology. Institutions wait for liquidity, exploit retail emotions, and do not chase price. Crucially, they trade based on probability, not hope. Consider the opening range scenario. The gap-up opening often leads to immediate buying by retail traders. Institutions then sell into this strength, causing the price to reverse sharply and trapping retail buyers. The lesson from the opening trap is to wait for confirmation and let emotions cool down. The first 15 to 30 minutes of trading are often the most dangerous. Traders need structure because emotions cannot be controlled manually. Rules reduce decision pressure, and structure replaces willpower. Professionals consistently trade systems. Our structured intraday framework has 4 key components: market context first, trade selection rules, execution discipline, and risk management. Market context analysis involves assessing whether the market is trending or range-bound and determining the volatility level. Differentiate between event days and normal days, and trade only on suitable days. Trade selection rules mandate trading highly liquid instruments with clear price levels. Avoid noisy charts and focus on one reliable setup, repeated daily. Execution discipline requires a predefined entry, a fixed stop loss, and a pre-decided target. Crucially, make no changes after entering the trade. Risk management principles are fundamental. These include setting a fixed risk per trade and establishing a daily loss limit. It is also important to define a maximum number of trades and prioritize capital protection above all else. Stop loss psychology is vital to understand. Hitting a stop loss can feel like a failure, and the ego often gets hurt. This can lead the mind to seek revenge, and most significant damage happens immediately after a stop loss is hit. Consider a case study, the first stop loss of the day. A trader risks 2,000 rupees, and the stop loss is hit in 5 minutes. This immediately triggers anger and frustration, leading to a critical decision point. A wrong response after a stop loss includes immediate re-entry, trading with increased quantity, ignoring the market structure, and ultimately leading to an end-of-day disaster. The correct response after a stop loss is to pause for 10 minutes, recheck the market context, and only trade again if a valid setup appears. The key is to accept the loss calmly. Regarding risk after a stop loss, after the first SL, the same risk is allowed. After a second SL, reduce the size. After a third SL, stop trading entirely. Remember, capital preservation is more important than confidence. Overtrading is often explained as trading due to boredom or the need to feel active. It stems from emotional discomfort with waiting. It is crucial to remember that more trades do not equal more profits. In an overtrading case study, a trader took 12 trades, but only 3 were valid setups. Small wins were wiped out by impulsive trades, resulting in a net loss despite having a good trading skill set. The emotional cycle of a trader often starts with confidence, moving to euphoria and overconfidence. A loss can lead to revenge trading, panic, and finally, self-doubt, continuing the cycle. To break the emotional cycle, establish fixed rules and limit the number of trades. Consistent journaling and focusing on the trading process rather than the profit and loss are critical steps. A daily pre-market routine is essential. This involves marking key price levels, defining your market bias, setting your maximum acceptable loss, and deciding on the maximum number of trades for the day. Post-market journaling requires recording your trade logic and noting any emotional mistakes made. Identify repeating patterns and focus on improving your process, not just your profit and loss results. In a consistency case study of 20 trading days, a trader had 9 losing days and 11 winning days. Despite the losing days, the trader remained overall profitable due to strict adherence to discipline. Consistency does not mean daily profits. It means following your rules every day, accepting losses as part of the job, and staying in the game long term. Adopt a final professional mindset. Treat trading as a business where losses are expenses. Discipline creates longevity, and boring, consistent execution is what ultimately leads to winning. My final message to you is this: markets reward patience, but punish emotional shortcuts. Structure is essential for survival in this business. Thank you for participating in this video. We will now begin a short segment for a mindset reset and icebreaker, designed to warm up your mind before the markets open. Let's do a trader reality check. Reflect on your trading from yesterday. How many trades followed your rules? Was your biggest loss emotional or technical? And what is harder, finding setups or following rules? Consider these questions honestly. Have you ever entered a trade without a stop loss? Have you moved your stop loss after entry? Have you overtraded after a loss? If the answer is yes, this session is for you. We are now moving on to the intraday trading basics, establishing the necessary foundation before aiming for profits. Intraday trading is truly a probability-based, capital protection business. It's an emotion-heavy environment, and it is not a job guaranteeing daily income. Beginners lose money primarily by trading without structure, using oversized positions, having no fixed routine, and expecting fast money. Take the case of a beginner with 50,000 rupees capital. Trading 10 to 12 times a day with no fixed risk per trade led to the account being blown in just 3 months. This highlights the cost of a lack of structure. Next, we delve into the intermediate section, structure and control. This is the path from market chaos to consistent control. Adopt a one-setup trading philosophy. Use the same setup, the same risk, and the same execution rules every day. This significantly reduces your emotional load. What is your current trading setup? Can you explain it in 2 sentences? If you cannot, it suggests you might be gambling rather than trading with a reliable system. In an over-trading spiral, the first stop-loss hit leads to an impulsive second trade, followed by a revenge third trade. The end result is typically a major losing day. Finally, we cover the advanced concepts focusing on professional thinking and the longevity mindset required for sustained success. Advanced risk management means risking less than 1% per trade and setting a daily maximum loss of 2 to 3 R. Stop trading after 2 stop losses are hit, always prioritizing capital over confidence. The advanced psychological edge recognizes that boredom is a trigger, waiting is a critical skill, and a no trade is often the best trade. Remember, consistency always beats intensity.